Hello and welcome, everybody. Private debt and real asset investing are two investment classes that have been growing in popularity among professional investors for some time now. Why do these investments fit well into the current market environment, and how can the two approaches be combined? I discussed this today with Florian de Sigy, managing partner at Flexam Invest Asset Management, who are part of the Kartesia Group. A warm welcome, Florian.
Thank you very much. Good morning, Thomas.
Private debt and real assets have traditionally been viewed as distinct investment strategies. So what makes their combination particularly compelling in today's market?
Private debt historically has been focusing on a recourse on the corporate and fixed cash flows. Asset finance, on the other end, has been rather focusing on the ownership of the assets and the possibility to monetize its assets in case of credit events. The combination, obviously, of both the recourse of the company and the monetization and the ownership of the asset through an asset finance strategy, as we do at Flexam, is offering clearly the best of both worlds.
What are the main structural drivers behind the increasing investor demand for private debt in real assets?
Yeah, I will name a few. First of all, there is a very compelling, attractive risk-adjusted return. Why? Because first, there is a security on the asset. Secondly, there are predictable cash flows. Thirdly, the returns are quite attractive. We are talking here about returns from 9 to 12% in euro, which are 500 basis points to 600 basis points above what similar company will provide on listed markets. And last but not least, the downside protection also, which we crystallize through a loss rate, is quite compelling. At Flexam, historically, we have a loss rate of 0.19%, so lower than 0.2%, which is to be compared, I will say, to investment grade, which range historically over the last 15 years at 0.4 to 0.6, so less than half the loss rate. Second point, diversification. It's clear that this strategy offers the opportunity to be diversified across geography, across sectors, across assets. And that is quite compelling if you think that also the correlation to the other asset classes is quite low. Whether you're talking about private equity or listed market, you see also the correlation is quite low. Third point, it is enabling through asset finance to have a very efficient ESG strategy, because you're really tagging your investments to an asset. So you can really measure in terms of CO2, for example, what is the impact, what is the reduction. And last but not least, I will say, the deepness of the market is quite significant. We're talking here about a very large market. And to give you an idea, last year we had more than 10 billion euro of opportunities to finance, which allows us to be extremely selective. So those are, I will say, the kind of four key criteria that are making this strategy quite compelling today as a private credit strategy.
How do volatile interest rates and inflation scenarios, as we currently see them, impact the attractiveness of private debt strategies in general and in the real asset space?
Yeah, that's a very good question, because inflation is very often seen as a threat. In our case, in asset, basically, inflation is a friend, I will say, because if you have a credit default event, you repossess the asset and you will either release it or sell it. And through that, you will do that at a higher price in an inflationary environment. So that's one thing. The second thing in terms of inflation is that creates an increasing demand, because higher rates make classic corporate financing more expensive, leading to borrowers looking at alternative markets, typically private markets where we have. And mechanically, inflation is pushing usually interest rates higher, and therefore is offering for us higher return and not necessarily higher risk. So adjusted risk return is also beneficiary from that inflationary environment.
So then let's turn to your investment strategy. So what is the investment thesis behind your approach to asset finance, and how does it differentiate itself from other private debt funds?
The approach here is structured around, I will say, three main blocks. First, what we look at is to identify assets that are cash flow generating for the company. They have to be centric. So we'll have a comprehensive due diligence on the asset we will finance for the company, making sure that it is also produced by a reliable manufacturer, that there is an established secondary market, and that we can identify clearly the cash flow that this asset will generate for the company. The second thing is we will clearly do a comprehensive due diligence in terms of the financials, looking also at the cash flow forecast as well as the business plan. So I would say that's the first part of the analysis, which is relatively traditional. The second part is also a very robust deal structuring. Again, in asset finance, you want to have a recourse on the company. So you will here securities, establish an LTV that is appropriate, that you can have a recourse, but you will have a second leg, which is also to ensure that you have a strong asset ownership of the company, so that in case there is a credit default, you can monetize rapidly your investment. And that is something that is not to be underestimated, because even if you have a pledge on the asset, sometimes it will take months or years until you can enforce and prove to the court that you are really the owner of this asset under the breach that has happened, and then that you can monetize. In our case, we own the assets from day one. And so if there is a credit default, it's just a breach of a commercial relationship, and we are free to move with the assets. So that's very important. So first, comprehensive due diligence. Secondly, a robust deal structuring. And I would say the third thing is to have a proper diversification. I mentioned it a bit earlier, spreading the exposure through sectors, geographies, counterparties that build a strong portfolio with a resilience that will prove that in difficult times, the loss rate is lower. As I mentioned earlier, this has been the case for us over the last 10 years through our track record.
So adding directly to this, how do you assess and mitigate risks in real asset-backed private debt financing?
I think that the package I just described here is explaining quite clearly how we mitigate risk. Our thesis in investment here is we want to invest in assets. We want to work with the low mid-market companies. Just to mention that those low mid-market companies represent 99% of the corporate in Europe. So this is a huge universe. However, those companies are smaller. We're talking about companies with 5 to 15 million EBITDA, with 50 to 200 million turnover, average rating at crossover. So you need to be here because there are a lot of opportunities, but you need also to make sure that you are here tomorrow by ensuring what I describe as the full package, due diligence, strong security package is protecting your investment. So looking at attractive return, but with a very defensive approach on the other side.
Can you share some examples of asset-backed financing deals the fund has executed and the types of assets you typically are financing?
Yeah, certainly, Thomas. Let me take one example that we financed in one of our first funds. Was a Swedish company specialized in fleet transfers. So basically their job is to transfer crews from the shore to the offshore wind farm. So we're here in a renewable energy space, where you will have on a regular basis the need for technicians and engineers to come and check the offshore wind farm. They were at the time number 5 in the market, looking to acquire one of their competitors. However, the target company was too expensive. What we did is basically to split in two. One side was the company with the manco, if you want. The other side was the asset co. And what we did is to finance the asset co, and therefore they were able to take over the company. We basically leased the assets, so the fleet of 25 vessels over a period of 5 times to give them the time to digest this acquisition. And they became, in the meantime, number 1 in their space. So a very interesting experience where we see that using asset finance has enabled, in that case, the company to move up in the ranking of the company in the market.
For what kind of investors is a private debt and real asset strategy typically suited?
We have different kind of investors ranging from high net worth, because the story is relatively simple to understand. You basically finance companies, they produce revenues, they pay you on a regular basis revenues, you repay your investors, and therefore you de-risk over time. And doing that, you contribute also to the real economy. That's something that high net worth family offices have understood very early. And this diversification that I mentioned earlier was and is still a very attractive thesis for them. We have also institutional investors. Their appetite comes from what I just described, the economic thesis, but also because the way we structure the funds enable basically through various points that are considered under Solvency II to have a low SCR, so solvency capital requirement, in our case, of 5% on average. This is quite low if you think that in private equity, you have a requirement of 49%. So institutional like the strategy because it provides also regular distribution. It provides attractive return, again, 9 to 12%. But on the other hand, if you think at how much it costs them to invest in our strategy, they see that it's very efficient from an SCR point of view. So while we had initially in our first vintage a split of high net worth and institutional, which were halved, we are going now to 70% institutional for 30% high net worth.
Looking ahead, where do you see the biggest opportunities, but also challenges for private debt in real asset financing over the next, let's say, 3 to 5 years?
The markets, if you look at the surveys, typically KKR has produced some reports and estimate that the asset-backed finance market will reach 7.7 trillion by 2027. So the opportunities here are huge in terms of the market that can be addressed. Our pipeline is has doubled over the last 5 years. In terms of the challenges, I will say that you are talking about real assets. So clearly here, you need to have the manufacturer deliver the asset, and sometimes the supply chain can be a bit slower than one will hope for. So that's one challenge. You can face some regulatory uncertainty in terms of CO2, in terms of going all electric. We have seen recently that the EU has changed a bit on the cars, for example. We're not funding cars, but that has some repercussion in other sectors. And also in terms of liquidity, I would say the constraints are that it takes a bit more time to monetize your assets when you have a real asset than when you have basically something that is listed where you just have to click and sell. However, in front of that, the opportunities are very clear. The whole energy space has huge requirements with the 2050 carbon neutrality target that we have set ourselves in Europe. We are talking about massive investment. So we are in this very luxury space where basically we can really pick and choose our project. And add to this that the bank have massively retrenched also from the low mid-market space. What you have today is a market where on one side, the bank are basically easily financing the very plain vanilla asset like cars and so on, which is not the space where you're, but here you're talking about small tickets. And on the other side, they have dedicated asset finance desk, but those desks will look at transaction of 100 million plus. And in the middle, and that's true across the whole of Europe, you have transactions ranging from 10 to 90 million, I will say, that are underserved by the bank. And therefore, that creates huge opportunity where obviously the margins are less compressed than in other spaces of the traditional lending and financing space. And that's typically the combination of the demand on one side through the energy and other spaces together with the need of the low mid-market that create fantastic opportunity for a space.
So this was Florian de Sigy, managing partner at Flexam Invest Asset Management. Thank you very much, Florian, for being with us and sharing your insights into this very interesting investment topic, private debt and real assets.
Thank you very much, Thomas. Goodbye.